Recently, we've witnessed the markets in major turmoil, and all the fingers have been pointing at China. What will they do, they've asked. Today, we will discuss how China has dropped the interest rates. You came here for the truth, so let me unveil that for you. I want to get into this video. I want to go through it very quickly, just cover the few points that I need to, and just to make you think about a few things. There are many different things I want to get to. I don't have much time today, but I wanted to just quick overview of the US stocks tumbling on Monday, the Dow Jones dropping to an 18-month closing low. So what we have here, they plunged actually over 1,000 points in the first 6 minutes. So as soon as the stock market opened, it crashed downward. 1,000 points is a big number, even though that percentage-wise may not be historically the most ever. And this right here said, before pairing losses as traders and mutual funds and other investors began to step up and buying up the stocks. Well, that's not exactly how it works. It's the plunge protection team. It's the central banks. So this is what we had here from the day before, but now the response was made. China has cut its main interest rates to boost growth in the economy. Although that doesn't make any sense, that's what they've done. The People's Bank of China cut its main interest rate by 0.25 percentage points to 4.6% after 2 days of stock market turmoil. So, of course, they needed a response. They had to do this, and what was the result? Well, I'll show you that in a second. Just wanted to note it's the 5th interest rate cut since November. Think about that for a second here. They've already said 5 times through that there is a problem. When they have to bring interest rates down, they acknowledge that there is a problem. Right at the bottom here, you're talking about the different stock markets that have risen as a result of this decision. This is just a few examples here. You look at the different stock markets around Europe, and of course, they're all doing well. Why? Because they've known that there are central banks out there who are willing to print money, willing to lower the interest rates. Free money and easy money will always make the stock markets go up, of course, with devalued currency. Investors remain concerned about the global growth in the face of plummeting commodity prices and slowing growth in China, the second largest economy in the world. This is a fact, and it is that they are worried, they are concerned about the major consumer of commodities in many ways, that is China. Look at this here as we see from my book. We're talking about China, among others, are financing the American consumption bubble, which leaves certain instability in the future. What if China can't buy? What if China decides to not buy from the rest of the world, whether that's buying up their debt or whether that's buying up commodities? This leaves a very big problem for the future. Let's look at this here. Out of The Guardian, financial markets have gone cold turkey over the past 7 years. They've been given regular dose of these narcotics, and they basically said, what if they pull out? And of course, they're not engaging in QE right now, at least on the surface level. And that's basically what they're trying to suggest, is that they're trying to pull the stimulus away, but what will be the result of that? I don't agree with everything in the article here, but it's interesting to note anyway. Unlike in 2007, the crash could be seen coming. That right there is completely false, because there were many who have been warning about it, and when you have the garbage that was running through the system, whether it's for the housing boom or whether it's all sorts of different things, we've seen how it was obvious and became the problem that we saw in 2008, but the problem existed long before that. Financial markets in the West have been booming for the past 6 years at a time when the real economy has been struggling. At least they acknowledge that. The real economy not doing well. Look at the civilian labor force participation rate. You will see how many people are employed is not doing well. I have other statistics on these as well. The home ownership rate down to a 50-year low. This is incredible. Okay, there's more in there, but I have to move on. This is out of the AP, just some interesting info for you. If you want to see it, you can either pause the video or just click on the link in the description. But what we have is that they're suggesting, trying to keep the markets calm, that in a percentage basis, this is not the historical large amount that we've seen before. Don't worry, 1,000 points, not a big deal in terms of the percentage. Here you could see some other drops that have occurred in history. China is censoring Black Monday on the country's biggest search engine, stopping citizens from looking at the information about the financial chaos. That's right. All you need to do is to censor information, and that will stop the public from wondering, stop the public from basically learning. And that's what's happening in China. But it's no different on a different level than what we have in the West. What they do is a lot more, let's say, not as obvious, but they do so. They're all owned by basically 6 media organizations or conglomerates, and what they have is a collection of ideas all under one umbrella, and that is disseminate their version of the truth onto the public. Let's look at here, as we see out of MarketWatch. This will probably be the worst quarter for the stock market destruction since the third quarter of 2011, when $2.8 trillion was wiped away. We are seeing lots of money being transferred, not evaporated, but transferred into the hands of the elite. Even when you see the elite so-called losing out on their money when these crashes occur, it doesn't really work like that, because they're the ones benefiting. I assure you they will be benefiting from any crash. Those who are not benefiting, especially, are those in South America. Right now, the Colombian peso drops the most since 2008, leading the global losses. Latin American currency slid to a 22-year low, and stocks joined the global sell-off on speculation that the region's economic contraction will deepen as Chinese growth slows down. So obviously, it is a global problem. We are in a globalized world. Mexico's peso weakened to a record, and the nation's shares are at a so-called technical correction after plunging more than 10% from their September peak. This is a very serious scenario because it's affecting so many different countries. It's not like it can be controlled and contained to one area. And then last but not least, wanted to go into this. In China, a ghost town points to shifting fortunes. If you want, you can read the article, basically suggesting that even in these once booming industrial towns, it's becoming a ghost town now. We're not talking about necessarily the ghost cities that we've covered here before, but just the fact that a lot of the industry seems to be moving away in these certain areas, and the people are not doing well as a result. What happens with all of this, because their manufacturing index is down significantly, and here's just some evidence. I'm sure there is much more to this, and we will surely be covering it as the days, the months, and the years go on. If you found this video informative, please give me a thumbs up. Last but not least, don't forget that my book is The Money GPS. You can actually flip through it. All you got to do is you go over to Amazon. They have this look inside feature, and it allows you to actually flip through the pages of the book and see if you like it. Take care.